I think it's maybe, more straightforward than that. I think, what we've seen over the last 10 years in the US IT sector, we've seen $1.4 trillion injected into the private equity market in tech companies alone. Now that's the equivalent of the entire profit pool of the technology sector in its entirety. And so it's an enormous amount of capital that's been put into that sector. And the valuations in that private market are extremely high. And what we're seeing is these large private companies come to the public market. The public market's not willing to pay that valuation and willing to reach the valuation levels that the private market is, which is why we're seeing this indigestion in these IPOs, and we're seeing the share prices struggle to perform in the immediate aftermath. But that's the nature of that market that we're seeing right now. The individual companies, I think some of them will have future quality characteristics. I don't think there's any question about that. But it's finding the ones that can be profitable and can actually drive that improving return on capital, can drive sustainable, profitable growth rather than growth kind of at any price, if you like. Then I think that's what we would look for. But I think we'd want that gap in valuations to settle down a little before we would look to get involved in that type of thing. Yeah, I mean, I think we would want to see a clear pathway to profitability within our 5-year time horizon. And if we can see a clear pathway to that with above average returns on capital and still strong growth, then I think that then they become candidates. So yeah, I think that's what we would look for. Yeah.